Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Abhilash and welcome to Cut to the Chase. Tuesday was yet another day in red for most major markets. US and European equity indices ended lower, while US Treasury yields jumped further as markets continue to position for a 75 basis point rate hike from the Fed. In today's podcast, I will be focusing on two things, the yen as well as what to watch out for in the FOMC meeting later tonight. Now let us start with the yen. The yen has been the worst performing G10 currency this year, weakening by nearly 15%. Overnight, dollar yen broke above 135.19 mark, marking the weakest level in nearly 24 years when yen last saw a massive bout of weakness following the Asian financial crisis in 1998. From a fundamental perspective, there are two drivers which explain yen capitulation this year. The first is the stark monetary policy divergence. So the Fed, as we know, has clearly stated its intention to front-load rate hikes and reduce balance sheet to curb inflation. On the other hand, the Bank of Japan is still trying to lift inflation and is unlikely to abandon the yield curve control policy till the core inflation stabilizes around 2%. Now, this has led to the widest differential between US and Japanese interest rates and has led to yen weakness. The second driver has been the fact that Japan is a large importer of oil and has seen its terms of trade fall sharply post the Ukraine war. And until these drivers begin to reverse, we think that the core dollar-yen uptrend is likely to continue and we see 137.50 and 140 as the next key resistance levels. However, in a rare joint statement last Friday, Bank of Japan, the Ministry of Finance and Financial Stability Authority expressed concern with the recent plunge in yen's value and promised a response in line with G7 principles. This has raised the expectations of the market that a currency intervention from Japan may be coming soon. Now, if you look at the recent history, Japan has intervened in currency markets in 6 instances or periods since 2001, and in each of those instances, it has intervened to prevent yen from strengthening further. The last such intervention came in 2011, following the massive tsunami that we saw in Japan. However, the last time Bank of Japan intervened to support the currency and prevent it from weakening further was in 1998 in the aftermath of Asian financial crisis. So if the Bank of Japan does intervene now, it will be the first time it would have done so to support the currency in nearly 24 years. Now, while a unilateral intervention without a change in monetary policy may not last long, the extreme positioning in the yen does raise the risk of a sharp pullback. So when we think about the divergence between the fundamental drivers and the idiosyncratic risks, we think that the risk reward for the yen is unattractive for now. Hence, we favor to take the exposure in currency space to commodity currencies such as Australian dollar, the Kiwi, as well as Canadian dollar, where we do have a stronger upside conviction. The second thing I want to focus today is the FOMC meeting later tonight, which could be a catalyst for big market swings. Financial markets have already adjusted sharply over the past few days and priced a near certainty of a 75 basis point rate hike later tonight. However, in addition to the rate hike announcement, I would be watching two things very closely. The first would be the updated dot plot, which is essentially a projection of how Fed sees hiking rates in future, and the revised economic projections. While the Fed is expected to reduce growth and raise inflation forecast, the magnitude of these changes would be closely watched by the market participants. The second thing to monitor would be Fed Chair Powell's press conference. Now, in the press conference, if Fed Chair Powell focuses solely on curbing inflation, then that might be viewed as a negative by the markets, whereas a more balanced approach between curbing inflation and growth could be viewed positively. So with that, let me end today's podcast. If you enjoyed today's podcast, please don't forget to rate and like it. Thank you for listening and wish you a very happy trading day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.